Good afternoon, everybody. Welcome to the General XLT session or XLT General Session. I guess that's the official name of it. But Scott McCormick here, and we are going to do the monthly market overview. A lot of stuff to talk about, but actually not a whole lot to talk about. I have some charts due to find from scratch. Kind of give you a little bit of the thought process that I go through whenever I'm analyzing markets. As I go through this, keep in mind that this is a presentation that addresses the long-term market conditions. This is not intended for short-term trading, whether intraday or swing trading. You can use some of that information to your benefit, but for the most part, this is really focused on more of a macro condition for the markets. And so as we go through this, if you have any questions about anything, feel free to put it into the chat. As I do this, again, I've got a lot of information that I tend to cover in these sessions. So as I see the questions come into the chat, I will address them as soon as I'm able to, because I want to make sure that I finish the point and not get too distracted and end up confusing everybody. So, all right. So with that, let's go ahead and get this show going here. And by the way, if you're new, if this is the first time that you are sitting in this session, go ahead and throw that into the chat and let me know, because it'll help me kind of formulate my presentation as we go through this. But for the and welcome, by the way. If you are newer to these sessions, it's going to be important for you to know a couple of background items here. So as a charter market technician, I had to study a lot of these models that I'm about to share with you. And it's important to remember, again, that this is from a long-term perspective. So we're looking at the market relationship through the lens of the economic cycle and the overall market cycle, and how we can use asset class and sector rotation to help us kind of visualize where it is that we might actually be within the overall cycle. All right. And the idea is that if you know where you are in the cycle, then you should know what strategically you should be doing and what you should be anticipating next. All right. Because if cycles repeat over and over again, then it's, the conditions, the catalysts that transition a market from a bull market to a bear market, those are always going to be different. But the fact is that the cycle generally tends to repeat itself, not always like clockwork, as you guys are going to see today. There's times when we have what I refer to as a mixed bag. But this process that I'm sharing here with you guys is something that I've been doing now for the last 17 years. I do this at the beginning of every month because I like to use end of month data in order to analyze those higher time frame monthly and even weekly charts. So with that, let's go ahead and take a look at our kind of screenshot here. Okay. Yes, this cycle is definitely like where we are right now. And I actually left this intentionally for this reason. And I'm going to walk you guys through how we came to this conclusion here. But when we met last month, okay, this is pretty much where we were looking, okay, meaning that we had a situation where bonds were trading lower, stocks and commodities were trading higher. So that kind of puts us into that stage 4 economic cycle. Now, just to kind of give you a little bit of background on the cycle, this comes from Martin Pring, who is a technician that has written several books that we had to study going through the Charter Market Technician program. But basically, the idea is that throughout an economic cycle, various monetary and fiscal policies will impact how these 3 major asset classes tend to perform during different stages of the economic cycle. And the idea is that if you identify which of those asset classes are performing at that time, it can give you a sense as to what stage of the economic cycle you're in. And as I stated a moment ago, what stage should be coming next. Okay. So, and notice the emphasis on the word should be, because when we take a look at what's happening here, and you guys will see this in a moment, bonds have basically been in a bear market since 2020. All right. They've been in a downtrend, but they've been bottoming out for the last year and a half now almost. And, so when you have a situation where you see that bonds have been in this major downtrend, you would think, okay, well, maybe we're in stage 4, 5, or 6. But when we look at how stocks and commodities have been performing, those have been moving higher. So that kind of puts us again in a situation where bonds were down, stocks and commodities were up. Well, as you'll see here in a moment, bonds have now broken out from this downtrend. And it's something that I've been talking about in the Guided Pathways session for some time now, watching this inverse head and shoulders pattern, which is a reversal pattern. And that is putting us now where, based on the past 12 months, it's looking as if though, and even over the past 3 months, it's looking as if though it's stating that we're in a stage 2. And then for stage 3 here, it was showing that that's basically where we've been for the past 6 months, which doesn't really make sense because we haven't really gone through a bear market. And I know a lot of people looking at how the market has sold off the last couple of weeks in the equity indexes. A lot of people are like, "Oh, is this beginning of the next down move?" And we'll take a closer look at that here. But ultimately, what I'm seeing here is what I refer to, and it's a very technical term. It's called a mixed bag. And what I mean by that is that we are in the situation where you expect it's like, hey, we should go from stage 4 to stage 5 to stage 6, but this is showing me here we've gone from stage 4 back to stage 2. We haven't gone through a recession, right? So what's going on? Okay. And that's where looking at the individual charts for each of these underlying asset classes is going to be very important. It's not just about looking at the performance of these, but let me go ahead and take you guys out to a website called stockcharts.com where we can collect this information. And I'll go ahead and put this link here into the chat for you guys. This is a free site. And it requires a little bit of formatting here, but basically this is underneath the performance charts from stockcharts.com. So when you go out to the website, you just go to charts and tools, and then underneath perf charts here, you can select the group. And the group that I'm going to look at first is what's called the intermarket study. And you get this line chart. Now, there's a couple of things that I'm going to do here. First off, I'm going to move the bonds to the beginning of this. Equities will be second, and commodities will be third. And we're going to get rid of the dollar index there. And we'll just update this. And so now we just have the 3 major asset classes: bonds, equities, and commodities. And the reason why I put it in that order is because it lines up with this model. Now, next thing I do is right down here at the bottom of this diagram or this chart, you're going to see this little histogram icon. I click on that. I switch this over to a histogram. And each one of these bars will let us know over a specific period in time how each of those asset classes have performed. Now, down here, this tells us how far back we are looking. So what I want to do is right-click on that, and I'm going to look at the past year. I always look at the past 12 months, 6 months, and 3 months. Okay, try to get a sense as to where we've been and where it appears we may be heading. Okay, and notice the language that I'm using, right? Should, could, may, might. I've learned the hard way. Never speak in terms of absolutes when it comes to the market, because it can do anything it wants to do. Our job is to kind of recognize what it is doing and prepare for it to change. Okay. So in this particular situation, when we take a look at the past 12 months, you'll notice that bonds were up, just fractionally up 1.32%. Stocks were up 17%, and commodities were down 3.33%. So if I were to take this information and try to put it in the context of the cycle, and ask myself the question, during what stage would I see that bonds and stocks are up, but commodities are still down? That's where we come to the conclusion that maybe it's a stage 2. Okay. But keep in mind that in order to really be in a stage 2, what should have happened? We should have seen not only a bear market in bonds like we did have a bear market in stocks, but that bottomed out back in October of 2022. And then we should have also seen a bear market in commodities, but we haven't, right? It's been going sideways, but it's certainly not a bear market. So again, it's a bit of a mixed signal here. When we take a look at the past 6 months, okay, same asset classes here, just change the look back period. And over the last 6 months, you can see bonds are up, stocks are up, and again, commodities are up, but albeit very fractionally. And so when we take a look at that, again, that puts us into the situation where if all three are up, we would suspect that we're in a stage three, which would make sense. If we were in a stage two, we would expect to move into a stage three next. But what really kind of furthers the confusion a little bit more, or adds to the confusion, is the 3-month look back period. Because when we take a look at that, we can see that bonds are up, stocks are up fractionally, and that's really kind of thanks to the sell-off that we've seen in the last couple of weeks. And then here we have commodities that are showing negative performance, and so that would kind of put you in the situation where bonds and stocks are up, but commodities are still down. Okay. So what I generally do from here is say, all right, well, that kind of gives me a sense as to where we might be in the cycle. So let me look at the next model, which is sector rotation, and see, if it's showing me similar information, or again, if I'm getting a different story. Most often, it's going to confirm between these two different models. But as you are about to see, again, it's a very mixed situation. So as we move over here to this next model, and kind of ignore all of these bubbles here for a moment, but the next model that we're going to take a look at is based on sector rotation. Okay, and sector rotation is something that happens throughout the course of a market cycle, and I have shared this before. Give me one moment here. I should probably make a favorite for this, but all right. So this is a website called the nber.org. It's the National Bureau of Economic Research, and what we have here is a breakdown of like all the different recessions that have taken place basically since like 1948, right? But right here underneath the business cycle dates, what this does is it gives a breakdown as to the different periods of economic expansion and contraction since 1854. Now, down at the bottom, what it does is it gives us a bit of a summary, and I generally focus on the period from 1945 to 2020, mainly because the Fed model has changed quite a bit since prior to that. They have a dual mandate for the Federal Reserve. So taking a look at this, basically what we have are several different figures here. Okay, so those figures are going to measure the duration of the economic contraction or recession, and then the expansion, and then I focus on the duration from trough to trough. Okay, so when you're measuring a cycle, you can measure trough to trough or peak to peak. It tends to be more accurate if you're looking at it from trough to trough. So when we come down here and we take a look at the periods from 1945 to 2020, basically what this is showing us is that the average recession since then, and of course, some are going to be a little bit longer, some are going to be a little bit shorter, but the average is 10 months. The average expansion has been 64 months, so just over 5 years, basically. And then you have 74 months for the total cycle, which is, about 6 years. So as we're looking at, these diagrams that I'm sharing here with you guys, it's important to kind of keep that in mind when you're looking at this entire thing. We're not talking about weeks or months. You have to think in terms of quarters and years when it comes to the duration of these cycles. Now, there's two lines here. The blue line represents the economic cycle. The orange line represents the market cycle. And as this is showing you here, generally what happens is that the market will bottom out and top out before the economic cycle bottoms and tops. Okay. Generally, the lead time is about 6 to 9 months or 2 to 3 quarters. But the purpose of this model here is to illustrate that during the different stages of the economic and market cycle, we would expect to see different sectors showing relative outperformance during each of these stages. Okay. And just like we would look at the asset classes and see that each of the asset classes has this different type of performance during different stages, the same thing is true here as well. Now the kind of yellow background bubbles here, these are the ones that were from last month, and here you can see these are the bubbles from this month, and we're just all over the place. It's pretty fascinating actually, because this is probably one of the first times in the 17 years that I've been doing this that it has been this dispersed in terms of where we're seeing the performance come from and how out of sync it actually seems to be relative to this cycle. Now, that said, let's go out here to stockcharts.com. Again, this is the same website. This is a different link, though, that I'm putting into the chat, because this one links it to the sectors. And what this is doing is it's taking the 11 sectors of the S&P 500 and it's making a comparison to the S&P 500. So if I deactivate this, you can see that over the past, let's take a look at the past year. So for the past year, all of the sectors have gone up in value, okay? Over the past year. Over the past 6 months, the sectors that have kind of underperformed here or were flat or negative is consumer discretionary and technology. And a lot of technology here, if you were to look at the XLK, you'll actually see that the XLK since mid-July has given up almost its entire year's worth of gains. It's kind of fascinating to see how much has been erased from that. And then if we take a look at the past 3 months, you can see that some of the early leading sectors here have turned negative, and you've got a lot of the late leaders here that have turned positive. But what I like to do is look at this relative to the S&P 500 so that we get a better sense as to what that relative strength or weakness might actually be. So when we're taking a look at this, what I can see is that over the course of the past year, the sectors that have been showing outperformance have been communication services and financials. So when we take a look at this screenshot here, that communication services bubble here, 12 months, financials, 12 months, that's basically where those two bubbles are coming in from, just showing us that, hey, over the past 12 months, these are really kind of the two sectors that have been showing the leadership, which is kind of interesting because you would expect to see that leadership during a recession and during kind of like a market bottoming process from those two sectors. And again, even though the economy may have slowed down during, with inflation and things of that nature, consumer discretionary is certainly not as strong as what it had been in the past. We haven't seen GDP turn negative, right? So I can't really say that we're in a recession. But as we take a look at the past 6 months here, and again, related to this model here, you can see that communication services still positive. Materials, staples, utilities, financials, and real estate have also turned positive in terms of relative performance. And so you would expect that materials are outperforming during a market top. Staples, utilities, real estate, financials, those should be performing during a bear market. But again, even though we've seen a sell-off in the last couple of weeks, it's not a bear market, and I'll show you that here in just a moment. So again, this is a bit of a weird signal that we're getting. Now, could it be the canary in the coal mine? It absolutely could be. So that is important to keep in mind. But as it stands over the past 3 months, communication services, staples, healthcare, utilities, financials, real estate. So the areas that are showing the most performance right now are those areas that would generally be attributed to a bear market, right? So again, could it be that we're finally starting to move into that period in time? It could be, right? You always have to be prepared for that. So here we have the asset class and the sector performance. And so when I have that, basically I'm going to stand back and just try to get an idea as to like where we are, right? Over the course of the past 3 months, it says that we're probably in a bear market, okay? Over the course of the past 3 months. But again, most of that selling that's taken a big hit on technology, that's only been in the last 3 weeks. I highly doubt that we've really moved into a bear market in the last 3 weeks, but who knows? From the asset class performance, this is telling us that we've already gone through the bear market and we should probably get ready for the next expansion. So again, this is a very, very mixed signal that is happening here, which is why I don't solely rely on this data to say, oh, this is for sure where we're at. In the past, when I've talked about having mixed bags, sometimes what's most important is to not figure out like where you are, it's to figure out where you're not. All right. And what I mean by that is that if we see that, stocks are starting to break down, then yeah, we're not in a stage 2. If we see that commodities are continuing to break down, then we're definitely not in a stage 3. So we need to look at each of the underlying charts to get an idea as to what's really, really happening. Now, on that note, let's go ahead and move over here to TradingView. I have a number of workspaces that I utilize. Each one has a very different purpose. What you're looking at here for this is the relative strength analysis of each of the 3 major asset classes, stocks, bonds, commodities, compared to one another. Okay. And I also have large and small cap as well as international versus domestic here. But this first chart that you're looking at, this is not a price chart. Okay. What this is a relative strength chart. And what that does is it compares the price of one asset to another. So in the case, we're comparing the price of the aggregate bond index and the S&P 500, which is obviously the index for the large cap stocks. What happens is that when you take that value, which is currently at 99.41, sorry, let me clear this out here. Did not mean to open that. All right, so if we take 99.41 and divide that by 522 even, that's going to give us a ratio of 0.19. Okay, when we take a look at this relative strength ratio here, that's about its ratio, 0.19. And so as we're looking at this, what this plot does is it plots out that ratio over a long-term basis for us. Now, if we see that ratio is in a general downtrend, that tells us that bonds are underperforming stocks. If we see that it's in an uptrend, that tells us that bonds are outperforming stocks. So the last time that really happened was back in 2007 going through 2009 during a bear market, which you would expect to see that bonds are outperforming. We got a couple of other spots here in 2010, 2011. There was even some strength there in 2018 and 2020. But again, the longer term trend here is to the downside. So from a performance standpoint and from a model standpoint, going back to this, if we were in a situation where, for instance, we're going into a stage 5 or we're going into a stage 6 or even a stage 1 where bonds should be up but stocks are down, I would also expect to see that ratio is turning higher for bonds versus stocks. And so when we take a close look at that, you can see that there's been a bit of an uptick since mid-July. It shouldn't be surprising. We have seen that the bond market has been trading higher over the course of the last few weeks. It's actually broken out of some key levels that we'll look at here in just a moment. But the other part of this is that the longer term trend is still down. So when I'm looking at this, trend reversals and terminations are a key event to let me know that, hey, we're really starting to see a rotation from one to the other. And at this particular spot, we've got 1926 for the most recent swing high and 1757 for the most recent swing low. So going forward, what I would need to see is that in order to terminate this, not only do I need to see the ratio trade up above that prior high, but I would want to see a subsequent higher low and higher high to suggest that we are actually seeing a reversal in this ratio that would kind of support the argument that money is rotating out of stocks and into bonds. And being that has not happened yet, that is not supporting the argument that we have moved into a bear market just yet. Okay, we're not seeing that rotation, although again, that rotation may be beginning. Okay, I think the confirmation here again would just be through a trend reversal, which just hasn't happened yet. But this is why you kind of continue to monitor these things on an ongoing basis. Now, I just observed that there was a bit of a data issue here for this ticker symbol. So I'm going to take you guys out to stockcharts.com. And what we're going to do is this is only going back for the past 5 years. So it's a little limited here, but what the ratio is the ratio of the CRB, which is the Reuters Jefferies CRB Index, this Commodity Research Bureau, versus that of the S&P 500. So if we see that ratio is going up, that's telling us that commodities are outperforming stocks. If we see the ratio is going down, stocks are outperforming commodities. And as you can see here, this trend is still to the downside. So I'll go ahead and annotate this here really quick for us. Let's see, they've updated their charts here. So the most recent swing high is done around that 0.06. And if we take a look here, it's a bit of a swing low, but that is in and around, and I don't know what that is. We'll have to call it like 0.05. But ultimately here, we can see that trend is down, telling me that commodities are underperforming stocks. Now, what I would expect to see, again, just going back to this model as a reference, is that if we were moving from a stage 4 into a stage 5, I would expect to see that commodities are outperforming stocks, okay? Much like what started to happen, let's see, where's the website again? So much like what started to happen back here in 2021 going into 2022, you had this situation where the downtrend here had terminated and you began an uptrend going into those final quarters, or I should say most of 2021, but certainly going into 2022, period in time where, again, I would expect to see that commodities are outperforming stocks. So that's not happening. So going back to what I said a moment ago, it's not just about understanding like where you are, but if you get a mixed signal, you got to figure out like where you're not. So in using some of these other tools, not seeing the outperformance of bonds versus stocks, not seeing the outperformance of stocks versus or commodities versus stocks tells me that we're not in a stage 5, we're not in a stage 6, we're not in a stage 1. Okay, we could still possibly be somewhere in between that stage 2 to stage 4, but I'm still erring on the side of a stage 4 just for the simple fact that we haven't seen any of these other downturns yet, and we haven't seen the commodities or the stock market go through a bearish cycle since 2022. Okay, so taking a look at the next item here on the list, let's go back here to TradingView. Now these are looking a little bit more closely at the internals of the equity side of things, if you will. What this is comparing is small cap stocks versus large cap stocks. And in this particular situation, you can see that the ratio has been in a downtrend for quite some time, which indicates that small caps have been underperforming large caps. We did see a termination of that trend last month when the small cap stocks broke out of the range that they were in. And they were in this range for quite some time. We'll take a closer look at that here in just a moment. But this is, believe it or not, actually a bullish signal. Okay, and because generally the old adage is that small cap stocks will lead going into a bull market, and they'll lead going into a bear market. And so, as we're taking a look at this particular situation here, you'll notice that we did terminate this downtrend line, but what has not happened yet is this. This is the major swing high right here. Let me get rid of these other bubbles to focus your attention here. So this is the major swing high for that relative strength ratio at about 42.52. So as we're taking a look at this, what I would be looking for is not just the termination of that trend line, but like we were talking about in the bond side of things, I would look for that termination and reversal, right? So I would want to see that we have higher lows and higher highs to suggest that small cap stocks are really starting to outperform large cap stocks for the foreseeable future, right? And again, that tends to be a bit of a bullish sign. Now, to take it a step further, one of the things that you'll be mindful of is that the interest rates, these stocks are very interest rate sensitive. So if we do continue to see that bonds move higher, we would expect to see that interest rates move lower, which should be a tailwind, if you will, for the small cap group of stocks. Now, taking a look at the next one here, this is the EFA versus the SPY. So in this category, you're looking at international stocks versus domestic stocks. And a lot of that kind of goes into dollar strength or dollar weakness. You would expect to see that during dollar weakness, international stocks are outperforming domestic stocks, U.S. stocks, and that during dollar strength, international stocks are underperforming the domestic stocks here in the U.S. And what's kind of interesting about this is that, as I pointed this out previously, we started to see a little bit of strength there in October going up through January of 2023, but we never terminated this long-term downtrend. And as a matter of fact, when you take a look at that, we've really kind of hugged this here. It was pretty impressive how much that trend line that's been in place basically since 2009 was kind of confirmed there in 2008, confirmed in 2009. We kind of approached that area and just continued to the downside. But in that situation, what happened is that we broke down below this last major swing low here. And as a result of that, it's confirming this major swing high. That took place back in January of this year. And as you can see in June, we actually continued to sell off a little bit more, which creates a kind of a short-term high here at 1549. So the one that I'm really paying attention to is this level here at 1797. But if we do get above that 1549, that's going to indicate that not only have we made a higher high, but we're also terminating that longer term downtrend for this ratio of EFA international versus the S&P 500. So if that were to happen, I would start looking for additional dollar weakness and start looking for more opportunities to invest internationally, whether it was through the EFA, maybe even looking at emerging market stocks, individual stocks outright, although it's safer to use ETFs when you're investing internationally, unless, of course, you're in an international market. But all right, so anyway, taking a look at these here, there's nothing from the relative strength analysis of these asset classes to suggest at this point that we're in a stage 5 or even a stage 6 or even a stage 1. All right. Everything prior to that has continued to indicate that we're in a stage 4. So what would I be looking for? Okay. What I'd be looking for is that as we begin to move from a stage 4 to stage 5, we should see that the relative strength chart between bonds to stocks begins to improve, meaning that we see this reversal that I talked about a little bit ago. In addition to that, I would expect to see that if we're moving from that, into that stage 5, even stage 6, we should have a situation where the relative strength ratio on commodities has improved versus the S&P 500. None of those things has happened yet. So I can't say that, we're in a bear market, but I would certainly, be preparing for that event. You should always be prepared for that event, but we'll take a look at the individual asset classes here in just a moment. Now, in addition to this, I will also look at the relative strength for each of these sectors here. So I also have a layout for those. We'll take a look at this group first. Okay, now the way that I have this set up is that you have 6 sectors here, and these 6 sectors that I have organized really kind of coincide with the first half, if you will. So if we take a look at this model here, this is kind of that front half that tends to be bullish. And then here we have the back half, if you will, that tends to be bearish. Okay. So everything from technology, consumer discretionary, industrials, consumer communication services, materials, and energy, those are all on this first group. Whereas the defensive areas, these are all in that second group. So staples, healthcare, utilities, financials, and real estate. So as we're taking a look at the groups here, okay, what we can see is that consumer discretionary continues to underperform. And as a matter of fact, It looks as if though we're starting to trade down below this prior low here at 32.81, which indicates to me that we're seeing the continuation of the downtrend. In which case, that's going to put your new swing high here at about 34.24. Now, I like to look for, in this case, it would have to be at least a weekly to a monthly close below that level. But at this stage, this is still in a downtrend. So when I look at the fact that consumer discretionary is weak, and it has been weak really since 2021, a lot of that is due to Tesla just getting beat up. It was a very large component within the sector. But ultimately, when you take a look at the fact that consumer discretionary, which is a leading sector, if I see that is, in a downtrend, then we're probably not in that market bottom, right? We're probably not in a stage 1 or even a stage 2, because if we were, I would expect to see that consumer discretionary would actually be improving, not continuing to deteriorate. All right. So again, it goes back to, understanding like not just where you are, but where you're not, right? To kind of figure out like where you are, if you will. Now, again, things change. This is why I look at this every month, right? And of course, we can check on this on an intra-month basis, meaning you look at it once a week or whatever, just to make sure that nothing has changed. But as you take a look at this, you can see that, again, we have not terminated this downtrend here, whether it's the major or the minor downtrend. So keeping an eye on those 34.24 to 34.81. If we do see that, we get some improvement there, especially if we do terminate this longer term downtrend that you can see, that would be a pretty significant clue there that maybe we are moving into a stage 2. Taking a look at the next one, and this has really kind of been the linchpin in everything. And this is probably the one thing that is bothering me the most. And I'm going to take you guys out to this website here really quick. This is the S&P Global site. What this is a breakdown of the S&P 500 by sector. All right, and this is another way of kind of viewing what it is that we're talking about here. But when you look at the S&P 500 and how it's broken down, you'll notice that not all of the sectors are equally weighted. So they update this at the end of every month, and it gives you the weighting for each of those sectors. And I want to point out that you have to pay attention to what that biggest sector or sectors are to get a sense as to what the broader market is most likely going to do. I pound the desk every month on this. And when we take a look at this, technology is the biggest sector. If that breaks down, that is a headwind for the S&P 500. Everything else could be going up, but if you have a situation where information technology is declining, one, that could be a canary in the coal mine. Two, it could mean that even if we don't break down, the market is not going to perform the way that it was when we have a situation where information technology, in this case, is actually doing well. Now, the other thing that I like to point out here is this. When we take a look at this, we've got 11 sectors, okay? 31.4%. Oh, this has been the largest sector for years, literally years. I can't even remember when it wasn't at the top of the list. I think probably one of the last times that it wasn't at the top of the list was back in 2006, all right? 2007, 2006, financials was at the top. So when you're looking at the top two sectors, all right, I want to show you guys this really quick because I feel like it's really important for you to understand this. 31% of the behavior of the S&P 500 is dictated by technology. 44.5% is dictated by technology and financials. When we take a look at the top three sectors, 56% of what the S&P does is dictated by those three sectors, right? Now, the thing about it is this: when you look at the information technology, the combination of financials and healthcare are not large enough on their own to offset what negative impacts information technology might have on the market, right? So you have to consider here for a moment. If information technology was down 1%, but financials and healthcare were up 1%, that's still not enough to offset that, because 1% of 31% is going to be 0.0031. Okay, when we take a look at 13.1 and 11.9, multiply that times 0.01%. That is not right. 0.131 plus 0.119 times 0.01. That's 0.0025. So you have a situation where information technology is still weighing you down by about 0.0006%, which I know doesn't sound significant, but when you look at what's happening here, what if not only technology starts to break down, but financials break down and healthcare breaks down? Well, now you're in trouble, because the top three sectors are all kind of going down, right? Now, if we go back here and total up the top five sectors, which is basically the top half of the index. So we've got 31.4, 13.1, 11.9, 10%. So that's 66%. And then communication services, that's going to put 75% of the behavior from the S&P 500 is based on what happens in those top five sectors. Okay. And so as we're looking at this, this is a significant reason why the markets just do what they do. Sure, industrials and staples and energy and utilities and real estate and materials could do well, but again, the combination of those sectors there, that's only 24.6% of the market. Not enough to offset what that top half does. It would basically have to outperform by 3 times just to have a washing out effect. Okay. All right. Let's see here. Let's go to this chart now. Okay. So this is the relative strength chart for the technology versus the S&P 500. And we talked about this previously. Back in April, we actually saw that the market broke down below this prior low. And we also saw that in June, it broke out above that prior high. So it was kind of sideways. But now we've broken back down below this prior low. And it's like, are we really sideways, or are we starting to see, again, kind of cracks in the foundation that would lead to more of a sell-off? So if we see a situation right here where technology is beginning to underperform the S&P 500, which is what this is signaling right now, then again, going back to this particular model, if we are looking at the fact that consumer discretionary is not performing well, technology is beginning to underperform, we are not at a market bottom, right? So let's continue to move forward here. Take the next sector, the communication services. So communication services here, it's kind of broken down below the short-term range, but the bigger picture range that I'm paying attention to is this, okay? This is the last swing low going into the last swing high. And as you can see, we're still very much trading inside of that range for this relative strength ratio. If we see that trade back up above 1613, that's great. But again, when you look at how much of an impact that would actually have, communication services is only 8.9% of the market, whereas consumer discretionary and technology make up 41%, right? So it's not enough to offset the negative impact of those first two cycles, or sectors rather. But the fact that this isn't necessarily breaking down yet is kind of a hopeful sign, if you will. I don't like to use hope, but here's the other part. If we know that communication or consumer discretionary and technology are weak, then if we started to see weakness here, you're going to have to consider that, again, we're moving into more of a bearish environment. So keeping a close eye on that 1513 is going to be important. Can somebody tell them to log out and log back in then if they can't hear anything? Because if I would tell them to, but they can't hear me. Anyway, at the next one. Okay. So taking a look here, this is industrials. And this is why, this is part of the reason why, rather, that it's been a little bit of a confusing situation here. So we've seen industrials kind of continue to underperform here. And as a matter of fact, I need to update this. So we have let's get rid of these. All right. So we put in a new swing low here in July, and we have seen these turn up, but you can also see that we're still in this downtrend. Thank you for that. So we're still in this downtrend here, but the key swing high that I'm watching is 24.34 to 21.18. But again, the fact that we haven't seen like real relative outperformance of the sector versus the market, again, suggests that, we weren't even, here, right? So I don't know, it's just weird. This is probably, as far as the cycle is concerned, this is probably one of the more confusing periods in time that I've seen in, again, the last 17 years. Okay. Taking a look at the next one here. Come on, where's my charts? Here we go. All right, so the next one is materials. Materials also continuing the downtrend here. Again, if you were going into a market top, right, meaning that you're in like stage 4, stage 5, you would expect that these two cycles, or these two sectors rather, would actually be outperforming. They haven't been. They've been underperforming. So it's kind of suggesting that maybe we're still in a stage 3. But if we're in a stage 3, I would expect that consumer discretionary and technology were still outperforming, but they haven't been, right? So this is just one of these things where you have to be extremely flexible when it comes to the market. Taking a look at energy here. Energy has also been underperforming. It's been underperforming since 2022. And, again, if we were going into the market top, you would expect to see that it's outperforming, right? I mean, if we come back here to like 2022, this was a period in time when it was outperforming, and you would expect that because, we were in a bearish market at that point. But it's not showing those signs right now. No, you make a valid point there because of the break in the long-term downtrend within the interest rate market. It's very possible that that's having a huge impact on how this model is kind of performing, right? But I can't abandon it just because of that. I have to got to remain disciplined, look at the information, and try to make as much of an informed decision as possible. Now, coming over here, taking a look at the defensive side of things, here's where things are kind of getting interesting, okay? So in this particular situation, you can see that we have had this downtrend here, which is still technically in place, but you can also see that it's accelerated to the downside. And we kind of broke that going into late July. And right now we are trading above this prior swing high, which is a key swing high that preceded here this swing low. So if we see here the reversal in this relative strength ratio, that could be a check mark to signal that, maybe you are actually here. Okay. Because if I start to see that outperformance there for that sector, that's giving me a clue that, we're not in any of these spots here, because everything else, with the exception of maybe communication services, that's relatively performing. But everything else here is saying that we're not here right now. Okay. This is the first sign of where we might actually be. Okay. Which could be like late to early stage 5. Okay. And I would actually say late stage 4, early stage 5. Taking a look at utilities, not utilities. This is healthcare. So this is another defensive area. You can see that this downtrend line has been broken, and taking a look at the last major swing low here, this is the swing high that preceded it. We did trade out above that area recently, indicating that we have some relative strength in healthcare versus the S&P 500. So in this particular case, again, what would kind of add to the argument that we are in that kind of the beginning stages of a bearish cycle would be the confirmation of the reversal here on this relative strength ratio. So again, that's kind of another check mark that this is showing relative strength. Okay. If we come down here to utilities, which has been basing sideways here, we actually saw a higher low put in July, and we're seeing a higher high at this point. And when we take a look at this downtrend here, that has also been broken. So here's yet another defensive sector that is showing signs that it is outperforming. And so we would expect these sectors to outperform not during the bullish stage, but during the bearish stage of a market cycle. Taking a look at your next sector here, this is financials. Okay, yes, I'm looking at weekly charts, but I'm paying attention to the longer term trends on these things. So taking a look at the relative strength here for financials, the major swing high that I'm paying attention to here is 0.0815. Getting a close above that would tell me that we have terminated this. But just like the other sectors here, especially with the evidence suggesting that maybe we are, getting closer to that market top, then I would be looking for this relative strength ratio not only to break out above this, but have that structure of a higher low, higher high as it does so. So again, we're not quite there. I can't put like a check mark on this, but we're certainly getting close to seeing financials outperform. And lastly here, this is IYR, which is your commercial real estate versus the S&P 500. Now, on this one, it's a little tricky, right? The longer term trend is definitely down. But what you will notice here is that we have started to see signs of relative strength, like the shorter term downtrend here, this most recent kind of impulsive phase, if you will, from April of 2022, that has been terminated as of mid to late July. So again, what I would be looking for here is that we see the termination or reversal for this relative strength ratio. It hasn't happened yet. The termination would be here at 1942. But if we see this kind of pull back and then take off again, that's going to be another signal to indicate that, you know what, we're probably here, meaning that we are moving into that bear market. Okay. So we do have some evidence here suggesting that we're probably transitioning from, and I'm going to take you guys back to this. So we're probably transitioning from that late stage 4 into an early stage 5. That's what all of this analysis is telling me. So if that's the case, what would I look for? I would look for the breakdown in stocks. Okay. I would look for the continuation of an uptrend in commodities. So that's where I start going in and start looking at the individual charts for those asset classes to determine where those key levels would be for our trend analysis, and of course identify the areas of supply and demand that relate to that. Okay. So from here, what I would do is come back from this analysis and I always do the abridged version on these. I think I did like a full version a couple of months ago. I want to say back in June. And, just looking at the trend for every single one of these, because as it stands right now, like if I were to just go through and look at the trend for each of these, okay. And as a cheat, I like to use the 12 and the 26 period exponential moving average. Okay. And as we take a look at all of these, I can see that, the trend here for the XLY, like we broke down this week below a key swing low. That's not good, right? Now we haven't closed down below that level. We could certainly see a move higher, but we could be witnessing the beginning of a break in structure. The same thing is true here for the XLK. We came back down and tested this level here from, what was that, in April. Okay, so erasing basically the last 3 months gains. Communication services, the key swing low here is at 76.48, so not as concerning as the first two sectors. When we take a look at the XLI here, the key swing low is here at 109.95, but in the short term here, you do have the swing low that's been defining the sideways range at 120.17. So if we get like a weekly to a monthly close down below that area, again, that would indicate that we're moving from an impulsive to a corrective phase. It could be a situation like what we had back in 2021 going into 2022. You'll actually notice that this went sideways for almost an entire year before finally breaking down. Taking a look at XLB, this is the key swing low here at about 80.74. But like industrials, it's kind of been going sideways here. So in the short term, I'm watching that 87.55 to see if we do break that level, because if we do, then again, we're moving into more selling action for that particular sector. And that would add to the relative weakness for that sector versus the S&P 500. On the XLE, this has actually been in a very interesting consolidation. You can see that we've actually had some higher lows here. We've had some relatively equal highs. We did break out of that back in April. So I'm going to go ahead and put this here at 98.97. But the key swing low that you want to watch for the XLE is 78.98. Okay. So technically, everything that we're looking at here is still in an uptrend to a sideways trend. Nothing has actually reversed the market yet on that. Okay. And then taking a look here at the other sectors. Okay. Staples has been trading at this area of supply here for several weeks now. But as you can see, the longer term trend is still up on the weekly chart. If you look at the XLV, again, we made a recent all-time high here, still in an uptrend. For utilities, this one actually reversed its long-term downtrend going into March. And since then, we've been in a pretty nice uptrend. And it's recently put in a new swing low there at 67.60. Financials here, still in an uptrend. Most recent swing low here, let's double check that, is sitting at 40.37. And then lastly here, and this is a pretty key thing that's happening, also very interest rate sensitive as well. This is your commercial real estate. And so what happened back here in, what was that, December of last year, we actually closed out above this last swing high, which kind of terminated this prior downtrend. And as you can see here, we put in another swing high. We've subsequently closed above that in the prior weeks, which confirms the swing low here at 81.75. So you actually have higher lows and higher highs here on the sector, which is indicating more of a beginning of an uptrend. So again, just taking this information and relating it back to this the cycle here, there's a lot of evidence suggesting that the trends for these sectors are looking fairly healthy, but the trends on these sectors back here, especially technology and consumer discretionary, not so much, right? Industrials and materials doesn't really look all that great. Communication services is okay. Energy is okay. So it's just one of those things where we have to, again, be prepared to see whether or not the markets do follow through. So paying attention to some of those key swing lows would basically confirm that, yeah, we're probably terminating the uptrends on some of those other sectors. Now, generally, before I go into all of the trend analysis there on the sector, what I do is I go through and I take a look at each of the asset classes. Okay, so for these, what I have is a fairly busy layout, obviously. In the upper left-hand corner, we have the 30-year bonds, and below that, we have the 30-year yield. To the right of that, we have the equity indexes for the S&P 500 and the Russell 2000. And I've stated this previously, but I don't analyze the Qs or the Dow Jones. Unless you're going to practice like Dow theory, there's really no need to look at that separately. Because all of those components are going to be inside of each of the sectors that I look at, and they're also going to be inside of the S&P 500. When you consider the Qs are going to look pretty similar to that of the XLK, and then also all of those components are going to be inside of the S&P 500. So I'm focusing on that and the Russell 2000, which is obviously going to be a very separate index of small cap stocks. Down here on the left, and I'm going to walk you guys through these on this one because I had to delete the chart because the commodity CRB index on TradingView for some reason hasn't been updating since June. So you have to use stockcharts.com. And so I've got chart of gold, copper, and crude oil that have to be updated. And then over here in the bottom right-hand corner, we have the dollar index along with the euro, yen, and British pound. So I look at each of those to kind of get an idea as to, again, where we are in the bigger picture and how that relates back to all of the other work that we've been doing. So for instance, looking at bonds, okay, so this is not the AGG, this is the 30-year bond. And I like to go out to the bigger picture charts first. I almost always start off with the monthly chart. And what I don't want to do this, but it's kind of busy in here, and I want to clean this up for you guys and kind of demo this process for you. I'm just going to delete it all. I don't want to do that, but I'm doing that. Okay, so first thing I ever do here is I always go off to the far left, all right, to identify what the big picture market structure is. I'm going to kind of ignore all of this in here because from this high, I can see that this is the spot where we actually closed out above that. We put in a swing high here, we retraced, we closed above this high right here. We continue to trade higher, we retraced, closed above this high right here. We continue to trade higher. We retraced, and then same thing, right? Now from here, I'm going to kind of focus on each of the shorter term swings, because as I'm doing this, I'm paying attention to the long-term structure in the market, but I'm also, as I get closer to where we are, I want to pay attention to the intermediate to short-term structure in the market as well to see where those kind of key swing lows and swing highs would be. That would indicate that we have a short-term reversal taking place that could indicate that we're moving from an impulse to a corrective phase. Now, in taking a look at all of this, okay, in terms of trend, currently we're obviously in a downtrend, and this is what I was talking about earlier. We've been in this bear market in bonds since 2020. When you look at where we are, this is the inverse head and shoulders pattern that I've been referring to. So you have a left shoulder there, your head here, your right shoulder here. The connection between the left shoulder and the right shoulder is what's referred to as the neckline. And from a measurement standpoint, that's important to understand, because if we do break that neckline, which did take place last month, this could actually indicate that the reversal is beginning. But keep in mind that we have two swing highs here that we have to get through. We've got to get through 125.33, and we have to get through that 134.14 to really confirm that, yes, we are reversing. Because right now, this could just be a false breakout, and we could see that bonds continue to trade lower. Now, on that note, I'm going to measure out the targets here. So I'm going to measure from the swing low here, which is from the head up to the neckline, and I'm just going to copy and paste that from where we actually broke out above the neckline to get an idea as to where the measure move target would be on that. And that's going to be in and around that 140 level for the bond market, okay? Now, in terms of demand, until we break out above this area, we don't have any imbalances on the monthly chart just yet, right? So I would be looking for a monthly close above that 125.30 to then start looking for some new weekly demand. That has not happened. So I'm not going to look for any new demand in this area, which means that you have to kind of come back into all of this mess. Now, in analyzing this, based on the data that I have available here, these are the two areas here where you had imbalances in the market, okay? You can see that all of this has already been tested here. So the next key level of demand would be down around in this area here, okay? And that's your next area. What I'm going to do here is just go ahead and highlight where it is that the market has already turned, because in these situations, even though that demand has been tested, this is indicating that we're more likely to see that a reversal is going to take place. Now, from here, what I would want to know, of course, are where are the key imbalances on the upside where we could actually see some supply from the bond market. So this is the major one, all right? And the reason why I say that that's the major area right here is because that is the spot where that long was confirmed and terminated below that monthly swing low. That took place back here in August of 2022. But from there, you will notice that there are some other areas, right? On the way up, you had some buying that kicked into the market there. We broke down below that area from here. So if you're dropping down into lower time frames and looking for where you might actually find supply on this, we're most likely going to find that we have supply that is up and around this area here at 147.08 to 150.30, 150.13 rather, and then coming back up into these areas here. Okay. So from a longer term perspective, if we do see that the bond market does follow through on this reversal, then you're most likely going to see that as we come up to these areas of supply, we could go from an impulse to a corrective phase. But again, this is very long-term analysis. I mean, stuff like that. I mean, this whole downtrend here that took 4 years. We could see that this uptrend takes a year and a half for it to actually develop. But paying attention to these key levels is really what's going to kind of help you out along the way to let you know it's like, hey, we've got some stuff happening here. Now, in the short term, we have seen some imbalances on the lower time frames, and that puts some demand here on the daily chart down around that 118 to 118.20 to 117.29 level for the short term. Okay. Now, if we do see that this is a false breakout, meaning that this is not an inverse head and shoulders at all, and the market's actually breaking down, the key swing low that you want to watch is this level here at 112.27. Okay, we've got to get through all of this here. And actually, we could probably even go so far as calling this level right there, because that's the most recent swing low prior to this. So 115.30. We get a close below that. That terminates this move, and it opens up the possibility of seeing bonds come back down to the lower end of that range at 107.28, which would then kind of take us back to, well, what kind of condition are we in? If we're seeing that bonds are down, stocks are down, then we truly are in a stage 5. Okay. If we continue to see that, stocks are falling, bonds are moving up, then we could be moving into that stage 1 area. Let's go ahead and take a look here at the equity side of things. All right. Normally, I'm just kind of pressed for time, so I'm not going to go through the interest rates. But if you're not aware, if bond prices are going up, interest rates are going down. If bond prices are going down, interest rates are going to go back up. It's pretty much that simple. Reason why I typically have this plotted out, though, is because there have been instances in the past where, especially as we were making like all-time highs, you did not have supply that you could work off, but there were instances back here where you definitely had demand that you can kind of time the inverse relationship with the interest rates, because there was still opposing supply and demand to work off of. Let's go ahead and take a look at the equity side of things, because I know that this is what everybody's pretty much worried about. When we take a look at this, I'm going through the S&P 500 here, and as you can see, I already have all of this marked up. And yes, it's kind of busy over here, but we'll take a closer look. Longer term trends are still up. Okay, that is without a doubt. Longer term trends are still up. Now, what has happened here is that if we close below the low from last month, which hasn't happened yet, I mean, we're only, we're in the 1, 2, 3, 4, 5th session here today, right? So anything can continue to happen. August is not historically the best month, nor September. But as you can see here, we have kind of entered into a corrective phase. Now, the key level that I'm watching here on the weekly chart is this level here at 49.53. Okay, we get a monthly close below that. That is going to be a key signal that this impulsive phase here that we've been in since October 2023 is over. You're probably moving into a larger correction. Now, the last time we had a bear market was in 2022. Okay, so if we just kind of measure the height of that decline and project that from the swing high, you can see that the projection here would actually bring us back down to the lows from October 2023. It'd be very interesting to actually see that happen. But that would actually line up here with that demand in around 41.79 to 40.80. And even if that happens, right? I mean, look at the longer term trend here that we have from the lows in 2009, lows in 2020. We would still technically be in what we've been in since 2013, which is a secular bull market. Okay, so there's a difference between cyclical and secular. Secular bull markets are bull markets that generally last for like 18 to 20 years or longer. We have a situation where back in 2021, going through 2022, that was a cyclical bear market, as opposed to 2000 through 2009, that was a secular bear market. Same thing as what happened back in 1969 going through 1982. So as we're looking at this, the behavior of those cyclical bear markets are very different than that of a secular bear market. So it's very possible we could see like 20, 30% declines, but very unlikely that you would actually see like 40 to 50, 60, 70% declines like what we saw back in the early to mid 2000s. Now on that, taking a look at the shorter term chart here, we do have some demand that is kind of left in this area that I'm watching at 5,064 to 5,013. Okay, now I didn't state this earlier, but my preference is to watch the cash index as opposed to the SPY or the S&P futures, because I have more historical information that's available to me here in this than anything else. Okay. So as we're looking at this, we're certainly in this corrective phase. All right. Now, in order for this corrective phase to show signs of termination and that we're back into an impulse phase and that the bull market is going to continue, I would, and I shouldn't say that like that, right? You never know if the bull market is going to continue. You know, it's like it might continue, right? So what I would be looking for is this, and I'm going to delete this because we've already made that measured move target there. So we'll get rid of those. But taking a look at where we are here, okay? One of the things that I do is I operate underneath a tenet from the Dow theory, which, to paraphrase it, says trends continue until they reverse. Okay, so what does that mean? Well, there are multiple trends and multiple time frames. What do we know? We know that the long-term trend on the monthly chart is still up. Where does that terminate? That's going to terminate here at 49.53. Where would it continue? It would continue above 56.69. Now, if we drop down to the hourly chart, right, we can obviously see that there is a downtrend on the hourly chart that has developed. That is the corrective phase of the monthly uptrend right now. And as we're looking at this, what I have to determine is, again, where would that reversal occur? Where is the downtrend termination? So I have to continue to follow that until either the long-term trend is terminated by getting down below that 49.53 with a weekly to a monthly close, or I see that this downtrend on the 60-minute chart has terminated. Now, we have put in a minor swing high today, but what I would really be watching is the swing high here from Friday's close. And if we get a daily close above that, that could be a signal that we have a higher low and a higher high that's been put in place, in which case I would start looking for some new 60-minute demand to take that market back up again, because that could be a clue that this correction is ending and we are going back into the next major impulse. Okay. Now, the last impulse that we had, and I'm going to take you guys back out here to a daily chart. The last major impulse that we had was from point A to point B. If Monday's low was the low, and if we are going to continue this uptrend, then what I would expect is to see that the market trades up to and around that 58.35 level. Okay. Now, based on the sector rotation that we were looking at earlier, I don't know how likely that's actually going to be. And, you know, that calls into question my longer term targets that I've had previously in the year at 6,100 as well. Now, in terms of supply, I don't like how this developed up here. Okay. When you look at the weekly chart, we have yet to close down below this basing area here. We do have a basing area that we closed below here, indicating that there was at least an imbalance on the daily chart. But when you go back and you look at where the supply is in that, you have a little zone right here that's already been tested. Okay. When you look back up into this area, could you use this as an area of supply? Potentially. I just don't like that because you have higher closes in each one of those. The market really wasn't kind of going sideways before it started to drop there. So you'd have to be very cautious about any of that supply up and around that 55.90 to 56.69. Okay. Let's see here. What else? Okay. So we talked about the current trend direction on the S&P 500. We've talked about where that long-term trend would terminate, where the long-term trend would continue, where the short-term trend would terminate. We've got demand, we've got potential supply there. So let's go ahead and take a look at the Russell 2000. I'm going to take you guys out to the monthly chart. So I'm going to update the swings on this. I deleted them earlier because I wanted to kind of, again, take you guys through this process here. But you can see the swings from that sideways action that the market had been in since 2022 going up into December of 2023. I mean, it was nearly an 18-month period in time. Now, for the next swings here, this is where we are right now within the monthly chart for the Russell 2000. So your major swing low there on the weekly and the monthly is 1931. So technically, the trend on the Russell 2000 is up. And that's good. The measured move targets that I have on this, there's a couple of them that I'm going to share here with you. So if you take the height of this range and project that from the point where it actually broke out from, you can see that gives us a measured move target that is in and around 24.24. That kind of coincides with the prior highs up there. But then I also have other measured move targets based on the prior swing here. Which gives us a target in and around 24.44. So what this would generally be referred to as is an area of confluence. Okay, that's when you have measurements from different areas that are lining up in about the same place. So that would be a place where I would look for the momentum to basically start to slow down. Now, of course, you can drop down to your daily chart and see, what type of supply, if any, you have in that area. Okay. And that would be around that 23.91 to 24.58, which obviously lines up pretty well there with those measured moves. Now, in terms of demand here for the Russell, okay, it's kind of tricky back here. I have this spot right here that I'm watching, and that's sitting at I'm going to go ahead and delete this old zone here, 1981 to 1967. But then the next area is well below that here, and that's going to be at 1882 to 1850. Okay. Let's see here. What else? The termination, again, of this longer term trend would be 1931. Continuation would be 2300. So if we see the termination, right, both of the S&P and the Russell, that again would be a signal that we are certainly moving into that stage 5, because until then, technically you're still in a stage 4, right? Because stocks are still in an uptrend. Taking a look at the shorter term chart here. So I'm going to drop down to the 60-minute chart. Okay. Just to do a similar analysis here with you guys. And excuse me 1 second, just have to sneeze. All right. Sorry about that. Okay. So looking at the 60-minute trend here, again, I operate underneath the assumption that trends continue until they reverse. I expect them to reverse at supply and demand zones, but that doesn't always happen. So I have to know where that market structure is. And as it stands right now, okay, the swing high that I'd be paying attention to here on the Russell, and again, this is on the cash index, the RUT, that's going to be at 2116. Okay, that's the level that I'm watching in the short term. So if we get a daily close above that level, that would indicate to me that we have most likely gone through a reversal and that we probably have some new demand coming into the market down on that 60-minute chart. Now, on the other hand, if we do trade down below this low here at 1992, then that tells me that the 60-minute downtrend is continuing and we're still going through the correction, much like that of the S&P 500. We get down below that 5119 level, that would tell me that the correction is still underway, and just to kind of rinse and repeat there. All right, I'm going to hop over here to commodities really quick because we are kind of running short on time here. So I'm going to take you guys through the monthly charts for each of these markets. Now, I say each of the markets, I look at gold, copper, and crude oil. All right. And normally what I will do, but I'm kind of short on time here, is I would also go through and look at the CRB index. Now, if just to quickly look at the CRB, and again, this is only going back 5 years, what you'll notice is that we're not in a downtrend. you know, it's a slight uptrend, but it's kind of just been range bound since 2022. So if we were to see that the CRB was breaking down below like that 260, 250 level, that would again tell me that, you know, commodities are most likely in that downtrend, in which case, you know, you're certainly in that stage 6. So that said, let's just come over here and take a look at gold, copper, and crude oil. So I'm going to go through the major market structure here on each of these. All right. And just highlight that. Okay. Now, the reason why I do this is several folds. All right. I want to know, one, what's the overall trend? Now, somebody could say, well, you could just look at the last 3 swings from the right to the left. Sure, I could. And that would tell me that I'm in an uptrend, but it wouldn't tell me if I'm in an uptrend and a major uptrend, or if I'm in a uptrend and it's a corrective versus a major downtrend, right? I like to go from the left to the right all the way, and it takes me all of 2 seconds. Now, the next part I want to look at is, what kind of phase am I in? Am I in an impulse or a corrective phase? Well, it's going in the direction of the trend, so it means it's an impulse, which means that I would need to take a look at the previous impulse phases here to get an idea as to how far those things actually traveled, okay? Because by doing so, it can give me a sense as to how far the next impulse might actually go. So if I project those arrows here from this most recent swing low, which is 1618 on the monthly chart, okay? So let's drop that down to 1618. And what that's going to do here, again, is give me a sense as to how far that market might actually continue to go. This is just simple measured move targets, all right? Because what you're dealing with here is a market that has no supply. So there's no real way of kind of knowing exactly like where that top is going to be. So it helps with measuring opportunity. It helps with not anticipating where the reversal will be, but you know, the closer I get to that, the more cautious I'm going to be. Now, in addition to that, what if we were to go through another correction? Well, relative to you know, where we are right now, the prior corrections were here and here. So not that we've put in a swing high yet, but basically what I would do is if we do put in a swing high, I would just do the opposite and measure how far those corrections might potentially go. Okay. Now, in addition to all of that, I would also look at where the imbalances were on the monthly chart to help me figure out like where that higher time frame demand might actually reside. And taking a look at this, you can see how this was a supply zone that really kind of held that market, and we finally broke out above that here. So when you drop down into the weekly chart, you'll be able to kind of easily locate like which zones you might actually want to pay attention to. Like this one right here, I would probably ignore. So coming back down into all of this area here, the spot looks like that's already been tested. So you're almost always, well, not almost always, but it looks as if though you're going to have to come back down here into these areas here, which would be fairly significant, right? If you consider how big of a decline that is versus where we are right now, that is from 2,500 down to 1,700, like 800 points. That's massive. Now, in the short term, if we do see that gold continues to trade higher here, and we do have a monthly close above this 2454 area, that could indicate that we do have some demand a little bit higher, but we haven't had that monthly close up there yet. As a matter of fact, it's just kind of trading above and trading below. Like we just closed above it last month. Not last month. What was that? Yeah, last month. Let's take a look at that. Yeah, so this is where the imbalance was, and you can see all this stuff was tested on the way out. So the only thing that you've really got left in here is this. That would be 23.41.60 to 23.04. And in addition to that, this swing low right here, this is your major swing low on the daily chart. So if we do get like weekly to monthly closes down below that 22.85 area, that's going to be pretty negative for not only gold, but also commodities as a group, because we could see downside to that, which again would, you are moving into that stage 6. Taking a look here at copper, same thing. Now, copper here, it had a huge breakout back in, March, April. And it looked as if though that thing was going to keep trucking, but it couldn't stay above that 5.03 level. So I'm going to take you guys again through the bigger picture here before we start focusing on all of that. So the old adage in copper is that it puts a floor under the economy and puts a ceiling on top of it, right? And let's take a look at this here. Never closed above that. So I'm focusing on the major market structure here. Close above that, we did. And now what I'm going to do is start going through the minor information right here, okay? All right, and as a matter of fact, I'm going to add in this bit right here. All right. So as we take a look at this, bigger picture trend, again, has been to the upside, but here's the problem. When you look at where the major swing low is on copper, it's all the way down here. As a matter of fact, it is right here at $1.91, right? That's pretty far away from current levels. Your major swing high on copper is here. So to see a continuation of a long-term trend in copper, we have to get out above 505, right? We're obviously pretty far from that happening. Now in the short term, if we break down to like the daily chart, you'll notice that some other key swing lows here are going to be in and around that 312 level, all right? Now on this, just going back to the higher time frames and looking for where, again, the imbalances have been on this. So this is on the monthly chart, okay? You had your drop-based drop here that was broken right here. And just taking a look at some of the other price action and how this is all developed. Not that this would be a supply zone that you would use, but obviously there was some selling that was right here in the market base and finally broke out above that. So these are what would constitute imbalances on not just the monthly chart, but also on the lower time frames. And the idea is that you're bringing in, order flow from multiple time frames. So just kind of dropping down here to the daily chart and looking at where demand would be relative to these areas. It just forces my perspective. So as I take a look at this, right, a lot of this in here, this is not my preferred location. I prefer to look at the areas that have preceded the test of that zone. You can see that this is where the imbalance was, but we started testing that back here. So a lot of this is just part of that initial testing phase, in my opinion. And so taking a look at where demand would be that precedes that, you can see that that's already been tested. And then you've got this area here, which also has kind of been tested on the way out. You know, it's at the extreme of that area. So it's possible it could get tested again. Okay. But taking a look at the daily chart, I really have to kind of come back down here to the beginning of it all, because you had this imbalance here. Okay. So this is where we started to kind of test up into that area. And again, a lot of that's already been tested. The only thing that I really see down here would be this spot here. Oh, and the spot here. Okay. In terms of measured moves and going back out here to the monthly chart and looking at like where the corrections are and such, we can obviously see that the most recent correction that we had was from point A to point B. Projecting that here from point C, you can kind of see the extent of that and really kind of forecasting a move back down to that 329.65 to 324.40. So I'd be looking more at this area as opposed to anything higher. You could watch these, but I would certainly use a confirmation entry on that. And then beyond that, you've got to come back down and around the spot here. Okay, you've got that one, and then might have this spot here. But even then, looking at the last major correction that preceded all of that, that was here, projecting that from that high of these, I'll probably be looking at the next one if we break down below that 312. Okay, so that would put copper there at 234. So again, if we break down below, that 355, subsequently the 312, that's again pretty negative for commodities, and reasons to indicate that you're in stage 5, even, or stage 6, even possibly stage 1 at some point. Last one here. This is crude oil. Okay. Nope, that is not crude oil. That is crude oil. Here we go. All right. Now, because this is the continuous contract, it's a little bit messy, but again, I prefer to just start from the past and go to the present. Okay. This is crazy. All right, so what I'm going to do from here is just kind of focus on all the shorter term swing price action. So ultimately, as you can see here, we have been in this consolidation on crude oil for really since May of last year. It's kind of interesting. So in looking at the last impulsive move here to the upside, that was from those lows there at 62.46 up to the highs here at 130. That was back in 2022. And taking a look at where we are right now, just again going through just some basic chart pattern recognition. You do have some lower highs that are happening here. You do have some higher lows that are happening here. So again, this is a consolidation pattern, typically referred to as a triangle. A lot of times it's a consolidation of the prior trend. So if the prior trend was down, there's a possibility we could see crude oil break out to the downside. So the measured move on that, there's a couple of measurements. First, you would measure the height of the base of the triangle. And then in addition to that, you would measure that prior decline going into that. So that gives you a couple of different targets there. So if we break out from this area, right, we could see that crude oil potentially trades down to 41.77-ish, which, consumers would certainly like. But again, that would be fairly bearish. And then projecting this from that swing high here, and I'm going to tack on another price line there. All right, and that would give us a target down at about $30 on that, which again would be pretty interesting to see. Let's see, let's go ahead and change the color on that. Now, in terms of supply and demand on this, when you're looking at the monthly chart here, the last major monthly imbalance that you had was here. Okay, this is where we had supply that was broken on the way up. And in terms of the monthly chart, there's really not a whole lot going on in there. You could potentially have some zones, obviously, down on the daily chart. So we'll take a look at that, see what we've got. Okay. And again, I prefer to look at the areas that precede where that higher time frame was tested. This is where the imbalance actually took place. But you've got this area consolidation here. You did spend quite some time there, so you'd have to be careful about that. And then coming back down into this area here, this is pretty much the next one. Okay. And so if we just kind of relate that to the bigger picture here, you can see where some of those measured moves would actually line up. So I would kind of err on the side of these lower ones here. 3606 to 3364, right? This area here, it's possible you get like old supply that becomes new demand. So it'd be interesting to watch. But, until we actually start to see monthly closes down below like the 67 or even this 65 area, I wouldn't be too concerned about the downside there. On the other hand, if we do see that the market moves higher here, it's very possible we could get back up to around that 130 area, which obviously would certainly be a headwind for most consumers. But in terms of supply, we haven't had any significant imbalances here on the monthly chart yet. As a matter of fact, the last one that you had was all the way back up here. Okay. And so looking back up into that area, that would be about 115.18 to 120. And then taking a look at this, you almost have to come to this extreme here at 142.38 to 147.26. And keep in mind that these zones here, that price is based on the continuous contract. It looks like that's already been tested, so that's done. So 142 to 147.26 would be the next area there that I'd be watching. All right, so I know I've kind of run over here right now, but let me try and offer you guys a bit of a summary as to everything that we've kind of looked at, right? So first thing that I ever do is I look at the asset class rotation to see which of these are, where we kind of seeing the performance to suggest like where we're at. And based on the analysis of the individual charts, I don't think that we're actually in a stage 2 or stage 3. Okay. The sector relative strength analysis is indicating that we are, probably more likely in that late stage 4, early stage 5, which means that I need to pay closer attention to any uptrend breaks within the equity markets. I would also want to pay attention to improving relative strength on bonds versus stocks, improving relative strength on commodities versus stocks. However, based on what we just looked at, with the exception of gold, copper and crude oil certainly don't look very bullish right now. They look more bearish than bullish. So, from here, again, this is where I think we're at, right? So from a demand standpoint, if you're looking at actually buying the equity markets as it dips, you may want to use confirmation entries on those and be very selective of the individual stocks that you're buying. Now, if you're trading the indexes outright, again, I would just simply, use confirmation entries on those zones, because if we are moving into more of a bear market, then you're more likely to see that we're going to go through a bigger correction and kind of come back down to about that 4,100 to 4,000 area within the S&P 500. But that 49.53 is going to be a very key level on the weekly chart that you want to watch, because it's a weekly swing low. I'm looking for a monthly close below that, which means that, yes, I might have to give up some downward price movement to confirm that. But, unlike Monday, where we actually had a lot of volatility, we could very well turn higher from here and trade up again, right? But this is probably the first time in, since 2021, 2022, where we've seen relative strength come from those late leading sectors, indicating that we're probably moving more into a slowdown. So from the equity buy side, from the long term, be very careful. There's probably going to be more buying opportunities in the bond market, especially if we get out above that 125 level on the 30-year, and with that, lower interest rates, which everybody in the markets are looking for. So, all right. I've not answered any of the questions here, so I'm just going to scroll back really quickly and see like what I had, because I had a lot that I wanted to get through, and I didn't even touch on currencies or talk about like the yen trade. But you can look up the carry trade online, and it's explained. It's pretty straightforward. But so I'm scrolling back here, and I've answered that. I've addressed this. Could it possibly be that inflation is masking the recession? Yeah, a little bit. Kind of talked about that here. Also, bull market is still intact, ongoing for the longest time. That is true. Now, I'd see the question here, how'd you get the chart? I'm not sure which chart you're referring to. If the market is an aggregate of the population's collective psychology, this chaos makes sense. Yes. Let's see here. answered that. All right. All right. Let's see here. Considering that we broke the 40-year trend of lower interest rates, it's probably not surprising that you're getting mixed signals. Yeah. Are you using weekly charts? Yes, I am. Let's see. Are you looking at weekly charts so that you can see charts displaying at least the length of an average cycle? So I like to use monthly and weekly charts. Monthly charts primarily, but for the relative strength, I use weekly charts because you see the change a little bit sooner on the weekly chart as opposed to the monthly chart, and it's not as noisy as the daily chart. Let's see here. I have heard of, I just came across that rule the other day. There was a question, have you heard of the SAHM rule? It's been very accurate. Yeah, it's called, I guess, like 52 of the last 52 recessions, and it just triggered for the 53rd time. So it's going to be interesting to see like what happens here. Let's see. Let's see. Yep. Okay, got all that. All right. Yeah, looks like I've pretty much addressed everything. Hopefully, you guys find some value in this. And just to kind of like wrap this up, this is again something that I've been doing every month for the last 17 years. And as I stated earlier, this is probably the first time where I've seen this degree of mixture, if you will. I don't want to say confusion, but there's a lot of deciphering that had to take place in this presentation than in previous presentations. Okay. But everything that I'm looking at right now is suggesting that, yes, we need to be prepared for the downside. I'm not saying go out and start shorting the markets right away because the party's not over just yet. But at the same token, let's put it this way, from a risk management standpoint, let's say that you're a long only investor, meaning that you don't short, you only go long, and you're buying asset classes, you're buying sector ETFs. If your typical allocation to new positions, let's say, is 5% of a portfolio or 10% of a portfolio, it's actually kind of high, but let's say 5%. At this stage, I would scale that back to 2.5%, right? Just to make sure that, if the market continues to go up, I've got exposure. But if the market continues or breaks down, then I'm not putting on as much risk as what I typically would, right? I would also be paying attention to the swing low there on the weekly and monthly charts for the S&P 500, because if we break that, then that means that I'm either going to have to lock in profits on the longer term positions that have been held in the portfolio, close out some of the ones that maybe are carrying a loss, or even enter into a hedging program to protect the portfolio for the equity side, right? That's basically where I think we're finally at. Okay. Because if I thought that we were closer to like stage 2, stage 3, it's like let's load up, let's get ready to get long. So, all right. Anyway, guys, again, hope you found value in today's session. We try to do these the first Wednesday of the month. Sometimes it's the second Wednesday of the month, just depends on holidays. As a matter of fact, next month we'll have Labor Day. So I'm not sure if the next one will be on the 4th or if it's going to be on the 11th. But either way, I will see you guys in the next monthly session. So until then, trade well and take care, everybody.